Okay, so how about like I think the most important thing what matters is that it doesn't matter who has been trading one day, who has been trading 20 years, who is trading prop, who is trading what. I think the most important thing is can you press 8 if you are a profitable trader, meaning that you can just trade without doing anything else, and you can support your life and your family's life.
That's a big question.
Perfect. So at least there is 1, 2,
Okay.
3. That's perfect.
All right.
Because it really doesn't matter. Like you can be trading 20 years or 20 days, but if you can support your life with trading, then you're already doing better than 85% of the people.
Okay. Actually, this Miss Elisa, the Miss Elisa, actually, she's the one who created the sample course that I will be sending to you next
Okay.
week. The one in English, the one that we can evaluate for MDT. All right,
Oh,
but their first question for you is, from your over 20 years of trading, what are the main reasons why traders lose?
I think the reasons have changed over the years, right? Because now expectations are different. Like if you have been trading for many years, then of course your expectations are the same. Market has just changed. But I think beginner traders lose because of the expectations. Okay, because the expectations is that you invest and then you make money instantly, especially nowadays. Okay, because especially nowadays everyone is looking for the instant validation. Okay, instant validation comes in different forms. So let's say that's why people use regardless what people can say, what the reasons why they use social media, psychologically it's just the instant validation. People can use it for business and what, but at the end of the day, if you use for personal purposes, it's just the validation. And it's regardless, it's man, woman, it's validation, because it's just you get addicted to the likes, to the views, and that's why they do it. Okay. And then when you have a person that starts trading, because we live in this instant validation time, then obviously you think, okay, so I watched some YouTube channels, I learned few strategies. Okay, so in trading, how do you get validated? Okay, with profits, right? So with profits, so you have this assumption, okay, now I'm going to start trading, now I'm going to start making money, because that's going to be your instant validation. And it doesn't work that way, because you could, like we discussed last time, you could have the best strategy in the world and you will still lose some money, right? Because it's a game of numbers. Nothing can be 100%. You have like 65-35 chances. So that means if you take 100 trades, potentially you could lose 35 in a row first, and then maybe you could have 65%, 65 trades in a row profit. And that's why people lose, because they give up. They give up too early, and when they give up too early, they start reapplying different strategies. So they don't stick with one strategy. They change the strategies. They change their own rules. They change completely, or they just give it to the fate. And sometimes fate goes their way, and sometimes it goes other way. Okay, so that's what's happening in my opinion. Now, why do experienced traders lose? Just one reason: greed. If like
Even experienced traders.
even experience, because greed can go different ways, right? It's not only about how much money you want to make, but let's say when you are trading for other people. Okay, when you do it as a business. Okay, as a business you get established, and it's very hard to hold on to your own strengths and to your own values. Let's say, let's imagine you are a trader with 10-15 years of experience, and you have clients and you trade for them. And those same clients are also investing with other people that at this moment, let's say, is making 10 or 20%. Okay, for that particular period, let's say for this month. So obviously those clients, they go and compare, and they go and tell to this trader of 15 years experience, and say, listen, I'm just trading with this guy who has only 5 months experience, and he made us 20% last month. Why you're not able to do the same thing? So the greed in this example is not that the trader now, oh, now I have to make more money for myself. Now the trader want to maintain his client base, right?
Yeah.
Because if he's not able to give the best results and the people compare, so what's going to happen? He's going to start taking more risk, because now you are in a competitive business environment.
Mm-hmm.
And then and the moment you start taking more risk than you should, you start making mistakes. So you deviate. There are no people in this world that, let's say, when you have your trading plan, that, okay, completely deviates straight away. I'm not going to follow any rules. It all starts by one step. Okay. You take one step, another step, another step, another step, another step. And by that time, you have taken 200 steps away from your trading plan, and your trading plan is completely different. And that is greed in a business environment, because you kind of have to reaffirm your position. Okay. And that's very complicated, because there's always going to be every year, there's going to be those one hit wonders, somebody that just come out on my FX book or come out in a trading community, and they are making obscene amount of results.
Mm-hmm.
But to be honest, after that, you never hear about them again, right? Because they make obscene amounts, let's say for 6 months, then they blow it, and they're gone. But because within those 6 months, they create such a hype, and then people just go and compare. Okay. Because the trading community in the world is actually not that big. Okay. They mostly are on the same forums, on the same chat rooms, everything. So it's not that big. Okay. So if everyone is talking about one guy, then people going to go and join him. And investments, they change hands. Okay. The pie of money is just one pie of money. It's not like magically all those investors make more money to invest. It's just one pie of money. So it just changes from one trader to another trader, from one investment manager, from one bank to another bank.
Yeah.
Okay. So, and that's why it's so competitive. And the competition can be very good thing, but also it can be very bad thing, because it will lead people to do the mistakes.
And I think that is based from your experience, right?
Yeah,
Because
definitely.
because we often, especially during the past years that we are discussing, that that there are some traders who are offering this much money, 10% per month, 20% per month, and then some of our clients are are going to that trader or to that broker, and then eventually after a couple of months they blew the accounts.
Yes, exactly. So, but those months are very hard for the established traders, because they genuinely, they have to deal with the customer service, and they genuinely start losing client base. And
True.
it's sad, because you know that you lose that client base, and if the person still will have money after that, they're probably gonna come back to you. But most of the times, those people don't come back because they don't have money anymore to invest. And then it takes them few years to build up the portfolio again. Now they have the investment, and then the cycle repeats. The cycle repeats. So people are very funny in that way, because they like to listen, like Warren Buffett. Okay. But he's a billionaire, and he's a very successful investor. However, people like to listen his lessons on YouTube. They like to read his books, but people don't like to apply them in real life.
Yeah, true. But for you, as a fund manager, how did you deal with that before? Because I know, like, one of your clients, he has like if I'm not mistaken, from 1M to 7M, you created his account from 1M to 7M after 7-8 years,
Yes.
and then
Since
right? And then
yes.
suddenly he went to some other like trader, and then he lost everything. Now he's trying to recover everything with you. How did you deal with it? Like emotionally?
Well, it's tough, but at some point, basically, you just learn to let people go, and that's it, because it's not worthwhile to try to keep them, right? Initially, of course, at the beginning, you try to keep everyone, because it's kind of good business practice. You don't want to lose your clients and so on. But at some moment, it becomes too hard. Okay. Because it's not like it's a one-off thing. Like basically every year at least you will have that. Every year at least you will have that one hit wonder coming on. Okay. And it doesn't matter. It could be from cryptocurrency. It could be from different trader. It could be from something. Okay. So it's just going to come on. Like initially again, it's not only trader, right? It could be crypto when it was crypto boom. After that, it was NFT boom, right? So people just, oh, now I'm just going to buy NFTs. Okay. Then there are some companies or some traders that for a few months do amazing, and then it kind of quiets down. So it's a vicious cycle. So how to handle it with emotionally? You just, well, number one, it helps if you have many clients. Okay. It helps if you have many clients and your clients comes from different sources. Okay. Because if it comes only from one source, that's also not really good business practice, because you lose the source and you lose your clients. But emotionally, of course, it will impact you, because let's say, like my example, a client was with us since 2015, and just in 2021, he decided to stop dealing with us and stop our services. And from 1 million, I think over the past 7 years, well, compounding, so compounding, but he has made like 7.5 million, and it took him six months to lose it all. So it took 7 years to build it, and it took 6 months to lose it all. And some people come back and they, of course, they can say, oh, sorry, it was mistake. Some people, of course, never gonna come back. But again, when they come back, they don't have money anyways. So deal with it emotionally is tough, because you cannot tell people, oh no, you cannot leave us. Okay. You cannot really talk anything bad about other companies, because again, it's not good business practice. So there's no other way. So at some point, you just have to let it go. You just let it go, and that's it. So and try to do better. That's why education is very important. The education is really important, because with education you can indirectly tell people how the market really works, right? There's always going to be these chances. There's always going to be something is going to go up, something is going to go down, and people are just, because people always get amazed about those amazing stories that somebody become a millionaire or billionaire out of pure luck. Somebody bought Bitcoin or somebody bought something and then you become a millionaire. But realistically, the chances are very small that it's going to happen to you. But if you listen to the stories that somebody built their wealth over the long period of time, actually the chances that could become with you, with me, with us are way bigger. But it takes way longer process. And again, because we live in an age on instant validation, people don't like long process.
Yeah, true. I agree. Okay, so just to recap, why are traders losing? For beginner traders, they give up early on the strategy or on their path. For professional traders, it is greed. For experienced traders, and of course for hedge fund managers, sometimes because of the pressure from clients, because there are like some traders who will be coming in with that hype of big profits. But for you, Sir Yanis, this is the second question. How do you measure your stop losses? Since for fund management companies, what we are really buying is the risk management, right? More than the profit. So for you, how do you measure stop losses?
Well, number one, it's very important to know where you're gonna generally stop out. Okay, stop losses on the one trade. Okay, that also depends how you trade, right? Let's say if you would trade like prop trading account or what, then you have very strict rules for the stop losses. But if you are in a business of trading, in a business of money managing, that means obviously if you're in a business of money managing, your target is to make money on the portfolio. Okay. Now, when your target is to make money on a portfolio, that means the bottom line is, okay, you are looking for more upside than a downside. Then there is a calculation. Let's say for me is quite simple, because we engage with agreements with the client. So we know how long the client will stay with us for, let's say, minimum period of 1 year or 2 years or 6 months. So we kind of can measure what would be the potential upside. Okay. So based on some kind of figures, let's say average monthly earnings, let's say if you can calculate between 2 to 6%, let's say you take the average 4%, then you multiply it by 12 months, it's 48%. Okay. So that means when it's 48%, obviously you want your stop loss to be, general stop loss drawdown to be lower than that. Then you can measure it, let's say 30%. Okay. So basically what you're having is you have 1 to 1.5 risk reward ratio. which is good. Okay, so that's how you manage, and so you take 30% risk against 48% reward. Okay, so that means that it's very logical explanation to your clients, guys. We are taking 30% risk, and we are potentially looking at 48% return. So it's one risk, 1.5 reward, slightly more than 1.5, and that's how you go with it. So and then you of course try to adapt your trading strategy, because of course you don't want to lose everything on one trade. But then if you trade in a blocks, like in a batches of trades, then it's a cycle, right? And then you have to look at the market, because I disagree that there is a fixed stop loss for every trade and all the rules are the same, because market keep changing. So of course the rules when it comes to stop losses and profits also will keep changing. So you have to learn the market. You have to learn the psychology, how it moves, right? So let's say like last week and the week before, Euro USD, GBP USD, USD Swiss franc, USD JPY, all the pairs against dollar has moved quite drastically, right? So you saw USD Swiss franc, USD JPY drop a lot, and then Euro USD, GBP USD went up a lot. So you have to understand market psychology, because you have two choices: you cut costs and start fresh, or you kind of fight the market. Not fight the market being stubborn, but fight the market and see where it goes, and then try to live it out. And that you can only answer in that particular condition, okay? Because the market conditions will change. But generally, you have to keep in mind that, okay, so you have this stop loss, let's say general stop loss of 30%. So you cannot exceed that risk more than that, because otherwise your risk reward ratio is not good anymore. And then you start calculations from there, depending on what products you trade, depending on what you do, because there are multiple ways. If you get, sooner or later everyone gets stuck, okay, in trading, because you will have, especially if you trade multiple positions, and then your ability to get out of these positions when you're stuck really forms you, because especially if you do business, okay? Especially if you do business, because when you do business, of course, you don't want to upset your clients, but also you want to grow your business. So to grow your business, you have to think what will happen. Let's say, what will happen if you will have 5% loss this month? Technically, it's nothing bad. It's just you're just 5% loss, but it will have very huge impact on your business, on your business growth, right? So there's so many variations. When you are in a business of trading, it's not just how good you can trade. When you are in a business trading, it's really important for you to understand how the actions of you, what you're gonna do psychologically will work on your team or on your marketing team, and so on, because that's what all the things that you have to keep in mind. Because as a trader, when you are making money by managing other people's money, it's very logical that you and your team will make more money if you will have more funds. The only way how to grow more funds is if you are somewhat consistent. Okay, because nobody want to invest. Like the moment you will have 5% loss this month, I can guarantee you that next month you're not going to get clients. And that's how it works. And that's why psychology, trading, and marketing is like you have to connect it all together. So to deal with the losses, if it's just as a pure trading, is different than how you deal when the trading is your business. Okay, so that's the thing. So when you are just trading is one thing, because when you trade your own account, you know what is going to be your probability, how much you're going to make, okay, in 1 year. When you trade for other people and you want to grow the business, you cannot do the same thing, because you know, okay, I rather make 0.1% this month than have 3% loss. Okay, it doesn't matter that maybe it's better for you to cut the 3% or 5% or 10%, and then you can still make 20%. Okay, but you cannot afford to do that, because you have to keep all the factors in mind. So that's why trading for yourself, trading for undisclosed funds that people don't see the trades, and trading for people that are in a live management are really, really different. So there is no fixed rules.
All right. So if there are no fixed rules, then how important is it to have a mentor in trading?
Because
Actually, that is
everyone,
another question, but yeah.
it depends on the person. Okay, it really depends on the person how important it is to have a mentor. Because there are people that are very self-sustained, okay, that can learn many things themselves. But at the end of the day, the only way how you can learn something is if when you learn from somebody who's better than you, right? There is no other way. You cannot learn from somebody who's worse than you. And it doesn't have to be mentor as people think, oh, mentorship means that on daily basis I'm talking with somebody or he's guiding me every step of the day. That way, mentorship can be something very different. Mentorship could be now I'm stuck and I call up somebody that I haven't spoken for a year or so and he helped me out how to get out of that situation. That's also a mentorship. So if you understand what is the mentorship in a general scale, then mentorship is really, really important. Because if you don't have anyone that you can go to when you're stuck, then how do you get out of the situation? What's the way out? It's the same thing like if in life, if you could have problems, right? Like there are people that are religious, but they don't go to church or mosque or any, depending on their religions, they don't go often, but they are still religious, right? But then when they are pressed down on their knees and when they have issues, then they go and they talk to pastor or they talk to ustad and so on, right? And that's the same thing in trading. Like I'm not saying that trading you can compare with the religion, but it's the same thing. You don't need a mentor that guides you every step of the way. Many things you really can learn yourself, but at some moment you will get stuck. So the question is, if you don't have anyone, to who you're gonna go? So that's why it is important to have a mentor, but it doesn't have to be like on daily basis.
Okay. Yeah, I agree. So, well, the intriguing question is, do you have a mentor up until now?
I do. Well, he's very old at this moment, so he's not really. But yes, I do. Well, I definitely used to. Now I would say that maybe not a mentor anymore, but then I just have like a group of people that are in a same industry, and that then we can talk and discuss.
Like peer to peer,
Yeah.
that, yeah. Okay. All right. So, I think we have to answer this question first. She asked, what is the difference of doing binary trading compared to the trading that iPro or MDT is advocating, or
What is
you are
binary?
advocating?
What is binary trading?
I don't know.
Uh,
I think she's a big.
th-
Yeah. Go.
the binary trading is like what's coming out where it's more of a volatile trading. Like you have to trade within seconds. There's no actual options trading pretty much, but it's something more gambling than trading.
You mean binary options?
Yeah.
Well, binary options is binary option. In my opinion, binary options is not really trading. Binary options, like you said, it is gambling, right? Again, like you can do calculative gambling, but see, when you trade, what you have is you have a target of price when it's gonna go. Let's say that's would be your take profit, and then you have your maximum risk exposure. That would be your stop loss. In binary options, there is no such thing because binary options are based on a time, not on a price. Let's say you could have 30-second option, you can have 1 minute option, you can. So in this life, there are no people that can predict the time. You can pinpoint the price target. Let's say, okay, gold should go from this price to that price. You can pinpoint that. There are no people in this world, and there is no AI in this world that can pinpoint that price at exact time. Because market is not a train station that you can have a schedule. Okay, it's gonna arrive in the next station. It doesn't work that way. So, of course, in trading there is still benefit of luck. Okay, there's benefit of time and so on. But in binary options, regardless how good is your skill, the luck plays bigger part. Also, when we talk about binary options, I haven't traded the binary options for very, very long time. So I don't know, I'm not very informed how good are the platforms. But if you look at the binary options, the price that most of the companies use is not really the same price that you would see on exchanges. Okay, it's slightly different, slight small delays. And let's say you play, and I say play because in my opinion, it's the binary options is a game. Yeah. So I've done it myself before. So, but it is a game because most of the binary option strategies are nonsense. With the Bollinger Bands, you go in reversal, then you keep doubling up until you're gonna make money and so on. It's same thing like a roulette. Like I used to gamble in online roulette, and I made a lot of money until they changed rules. So if I found a company that only have black and red, they don't have zero, okay, and then you just keep bashing on a one color. You start with a 10 cents and you keep doubling up, and of course at some point you will make money, okay. And then they change the rules that there is maximum bet. The moment you have maximum bet, that means you don't have those chances that sooner or later you're going to make money, because if you lose 16 times in a row and after that you cannot double up anymore, and that 17th time comes out, you still lost your money. And binary options is exactly the same way. Exactly the same way, because it's not about the price, it's about the time. So it's, in my opinion, still there is more luck factor than skill and technical analysis. I mean, you can analyze the price, but you cannot analyze the time.
Okay. But let us be clear, right? That this is not options trading. This is binary options.
No, binary options. Options trading is different, because options trading you are options trade. So binary options means that let's say you trade 1 minute option, one minute binary option. So that means it doesn't matter if within the 1 minute it went up, but when the time is over, if it went down, you still lose money. In options, it doesn't work like that. In the options, it can go up and you can close your option in a profit.
Correct.
So it's way different story. Options you can use for hedging purposes, like you can buy underlying asset. Let's say you can buy Apple, but then there are some factors like COVID, so on, or like there's earning reports, and we saw iPhone has not reached their expectations. So what you do is, instead of just selling your Apple stock, what you do is you take the short options.
Yeah.
So options are good. Binary options is more as a game.
Yeah. Okay. How about for what is the trading that you're advocating? MDT, iPro. Yeah. For you.
What is the trading?
Yeah. Well, what is basically the education, your mentorship. What are you advocating in terms of trading?
I would advocate that there are so many different trading styles, okay, and there's so many different approaches when it comes to trading, that at the end of the day, those people who learn and come to the education, they have to, in the end of the day, they have to use their own common sense, and they have to find which of the approaches works for them, okay, because there is no point to teach, like what we do like in MDT, of course, like there are different levels. Let's say there is a beginner level, like let's say moving averages, Fibonacci's. You only gonna have as many ways how to trade with Fibonacci or with moving averages or with RSI, right? Nobody gonna reinvent the wheel, and that is the beginner stage. The same thing when it comes to candlestick patterns and figures, and nobody gonna invent something new. Okay, this is just how you see, like the cup and handles, the flags, bullish. It's all the same. It has been there since 1970s. Okay, so let's say if we talk about Forex was first, it started trade on 1971. Okay, and all these signals have been there since 1970s. Nobody reinvented moving average.
Yeah, true.
Then they came exponential, then they're triple and so on, but nobody reinvented. It's the same thing. Okay, but it is our job and your job as a trader to find out what works the best for you. Let's say in MDT, we could teach you 20 different approaches, because it depends on, let's say there are some strategies that you can only trade when the London market opens for the first half an hour, and when the New York market opens for the first half an hour. For a person that has nothing else to do in his life, probably these strategies are really bad.
True.
But for a very busy person, probably this strategy is really good. But maybe some of you is a surgeon, and when the London market opens, most of the time you will have a surgery. So it's not applied to you, right? So there is no such thing that, oh, this is the best strategy, because what might be the best for you might not be the best for me. Okay, so that's why it's very important not to teach one approach. You don't want to teach people, and let's say in MDT, we don't want to teach people our approach, okay? Because there is no such thing as our approach. Trading is very straightforward. You either make money or either you lose money, okay? And the idea is to make money in investing over time. The idea is not to make money on that particular trade. Idea is to make money over time. The idea is to have a setup that you make money every year. So you might not even make money every month, but you make money every year. So that is the target, okay? And then the target is to teach people various strategies, various approaches that they can decide themselves what works best for them.
Exactly. Okay, Ma'am Joanne, did we answer the question? Okay. Anyway, while waiting for her reply, sir, what can you say about martingale's strategy in trading? Asked Sir Armel.
Many people say many bad things about martingale, but to be honest, it's one of the best approaches that you could find. Also, it's one of the riskiest approaches that you could find. So I think any person can make money with martingale, and any person can lose money with martingale. It comes to, first of all, what exposure you're using. Okay, most people like martingale strategies because that's how you can show people that you are making like 20 or 50% a month. I myself, I've doubled some accounts in a few days, and then you can lose it in the next few days. So it's, but does that mean that martingale strategies are bad? No, not necessarily. It just depends how you're going to use them. You can still use martingale strategies in very, very diverse and very smart way. Okay, let's say in our trading systems, we use some sort of approach, like similar approaches as martingale, but just like not like bluntly having a pure martingale, sooner or later you will lose money. But can you use martingale strategy to a certain point? As long as you know when is your cutoff or when is your stop point, where you stop, then you can use it. Okay. Of course, if you do this way, you will never make like 50% a month on consistently basis. Yeah. But it's you can still use it. And there is nothing bad with greed or martingale strategies, especially how volatile market is now. People think, oh, you have to find one good entry, and you're not going to find it nowadays. You're not going to find it because there is a zone, there is a buy zone and sell zone. There is now I think we talked last time that there is no straight line. You don't have a straight line. There is a buy zone and there is sell zone. So, for instance,
will you be sharing your screen? Okay.
Yes.
All right.
Okay. So, for instance, if we are looking, so let's say S&P. Okay. So S&P. Okay. So we are looking at S&P. Okay, so and if we form this, buy zone here, okay. So if you form this buy zone, like if you just take this one point as your entry point, it went lower. So maybe some of you would cut loss by the time it goes lower, right? But if you take this as a zone and you do, as long as your position calculation is proper. So let's say if you're trading, for example, or if we take it as CFD, let's say 10 lots, or if you trade it as options, let's say you want to totally enter $10,000, it doesn't matter. So as long as you split your $10,000, it doesn't matter greed approach, martingale approach, but you stop here. This is where you stop. There is no harm with martingale strategy, right?
Yeah.
It actually can benefit you more than just having one single entry. But if you're just gonna keep adding positions until here, then you get into trouble. But there is no harm having, let's say, few positions in this zone. After that, you cut loss, don't cut loss. It depends of your margin exposure or what, but you stop. The most important is you stop it. And then let's say you start having your next grid here. There's no harm in that. But if you just keep bashing in and you don't know where to stop, you're gonna lose all your accounts sooner or later. But there are no bad strategies. Okay, there are no bad strategies. There are only bad approaches. Every strategy, you can make money with any strategy. You can make money with a single moving average, and you can lose money with a single moving average. So grid, martingale, averaging, hedging, there are no bad approaches. There's just bad execution.
All right. But I think the more important question is, how much is the amount of capital where you can apply martingale in a more comfortable manner? Because I think that is the question for most traders, right? They're asking whether martingale strategy is good for trading or not because of the limited amount of money that they have. Because, for example, if you have like $1,000 or $5,000 in your account and then you're applying martingale, no matter how good your multiplier is, at some point it will blow up. So what do you think is the amount of capital that is, we can say that you can be comfortable if you will be applying martingale strategy?
If you trade one product, then minimum $50,000.
Okay. One product, $50,000. What will be the multiplier for that?
So basically, you're not gonna add on position on every single position. Okay, so let's say what you have to do is you have to calculate your maximum exposure. Okay, so let's say if we go to the chart, okay, so that would be the calculation. Okay, so let's say we take okay, so let's say Euro USD. Okay, so let's say we start this as your entry. Okay, so you have your like me personally, I have some, like even here I have long position open. Okay, so I have long open. Okay, this is profit. Now let's assume that this is, we have a long open here. So we start in here. Okay, because we enter longs in here, we made money. Okay, so it went up, made money, fair enough. After it dropped, bam, this is, we open our longs here. Okay, so my zone, realistically, for this particular scenario, what I would do would be until here. Okay, because each zone is going to be different. You could have $5 zone, 50 pips zone, 100 pip zone. Okay, so when you have 50 pip zone, of course you will have different multiplier than when you will have 100 pip zone, right? So in this case, we have 10579 and 11. So basically it's around 150 pips, right? If I'm not wrong. So it's 150 pip zone. Okay, so then what is your risk on that position? Okay, so let's say on that position it's 10%, just example. Okay, so let's say your account is $50,000, 10%, so that means 5,000. Okay, then you have to do your calculation. Realistically, to be really safe, probably you are, and if you're not leaving to the chances, but you're really safe, then this is your take profit point. Okay, very, very short take profit point, and that's, you're not leaving anything to the chances. You're just doing proper analysis only. Okay, so this is your take profit. So obviously, to travel from here to your take profit point is way, way higher than to travel from here to your take profit point, right? So let's say this is 11264 and this is 1123. So basically it's like 15 pips only. Okay, so what you can do is, like what I would do, I would create a grid. Okay, I would create a multi-angle grid thing. So let's say you can enter every 5 pips. Just start with the smallest, so 001, 001, 001, 001. And let's say I would do that for 10 positions. So without any multiplier at all. Okay, because if you have 50K, of course, you cannot do 001, 002. There's not a lot of room for you to go. Okay, so it depends how much money you have, but if it's 50K, so that's what I would do. And then after the 10 position, you would do 002, because again, you cannot use smaller multiplier. You have to go double up. Okay, and then 003, and then I would calculate what is the total risk, and then I would know what is the last position size. As long as it doesn't exceed, so you would set our stop loss, let's say, would be here. Okay, so this would be the stop loss point. Okay, that means we're not going to enter positions anymore after this zone is broken. Okay, so you're going to stop multiplying. You're just going to let it go. You're not going to enter positions, and this is going to be your stop loss. So that means as long as you're not losing more than 10% in this position, and this way you give yourself a fighting chance.
Okay.
If you're just going to multiply it from here all the way here, your 50K are blown, even if you start with 0.01 lot.
Yeah, true. All right. Okay. Did you understand that? Clear? So there's no problem with martingale strategy, only a problem of how much money do you have so that it will be comfortable for a martingale strategy.
And when you have to stop, and when you have to, because you have to understand that sooner or later market regardless will go against you. It could be in this scenario, it can be in different scenario. So you have to know when you have to stop. You cannot just keep bashing positions, because there are many factors. Number one, there are such things as maximum lot sizes, right? It's not like you can go into unlimited position sizes. Different brokers, different scenarios have different maximum lot sizes. So there are those factors you also have to keep in mind. There are brokers that you can go as high as 200 lots. There are brokers that say that they don't limit the lot sizes. There are brokers that you can go as high as 100 lots, as high as 70 lots. Is different. So that's you have to know from the get-go, and then you can. That's probably where you should start. Then also you have to know at what margin percentage exposure they will cut your positions. That's also important to know, because the last thing what you want is that, oh, I calculated my margin wrong, that I still have equity, but I don't have margin percentage left to enter any positions anymore. So there are many factors. So again, no strict rules, because you have to know where you trade, what is the trading environment, what you trade, how much money you have, and all the other factors. Swap also is an important thing.
Well, there are a lot of information, right? Is there a way for us to like simplify everything, or that's just trading? Because of course, if you will be going to social media, they will perceive trading as it is simple as buy, sell, and then you will earn already. But based on what you said, you have to know the swaps, the margin level, the broker, etc., the spreads, when they will enter, when they will be cutting the what do you call this? The time of when you can trade, right? Because different
Yes.
brokers, they have different opening and closing of their servers, etc. So it is as if it's too complicated. Is there a way for us to simplify it, or that's just trading? That's just
There
the
is.
reality.
Of course there is. Just don't trade. The most simplest approach. That's what I mean. It's like, of course, when you just start, you don't want to bother with all those things. But if you want to pursue it as a career and you actually want to make money, there is no simplified approach. If you just start, of course, there are these things probably is not going to be important to you, let's say in your first year when you just start learning. But if you start really trading for other people, then unfortunately there isn't any simplified approach, because those are very, very important factors. Very important factors. And then that's you have to find out. Simplified approach would be if you just enter one position and then you see where it goes. Okay, so you could have that, but again, then you're just not going to get the best out of the market what you could. So that's the problem. So if you just want to trade and do it as an action, of course there can be simplified approach and there can be simplified rules. If you want to trade and pursue it as a career, unfortunately, there's not going to be simplified approach. Imagine if you're a surgeon and you're doing a surgery, and are there simplified rules? Of course, there are some simplified rules, but then imagine you get a patient, and the first thing what you want to know is their heart condition, their blood type. That's the same thing like in a broker about the commission swaps and the cutoff times, lots, and so on. That's exactly the same thing. And when you are trading for people, you should put yourself as a position like you are a surgeon, okay, that you are performing a surgery. Okay, yes, there are simplified approaches, but if you're not going to follow through on those details, it can be disastrous. Imagine if you have a blood type O and they gave you a blood type 1 instead. You could have a successful surgery, but the patient's still going to die. They're going to go in a cardiac arrest. There are going to be issues. So that's the same thing. You could do simplified approach, but if you do it as a profession and you do the simplified approach, it will end up badly.
All right. Okay. One moment, maybe because there's someone who asked. All right. For those, because she said that she has to go. Okay. Well, maybe for inquiries, you can just email us here on the email posted below, or you can message us on the WhatsApp number that is posted below. Also, the Facebook page of Million Dollar Trading or iPro, that is for the reviews page. So if you had some information or insight or knowledge that was added to you listening to Sir Yanis, maybe you can just give us some honest review there. Okay. And for the email, what they call this? Shared replay. Yes, I will be having a replay for those email addresses that registered in this Zoom meeting. All right. Okay. So thank you, Sir Yanis, for that. Well, next question is, do you believe in diversification or do you focus on a specific trading niche?
Me personally, I do believe, but the diversification also is can work against you. Okay, so it depends at what level you are in your trading career or in your trading experiment, in your trading life. Okay, so if you're a beginner trader and you diversify too much, what will happen is that you will never learn to trade. Never. Okay, because you will know some things about many things, but you will never know a lot of things about one thing. Okay, so and that means you cannot be a professional. Okay, because there are no such thing as professionals. Let's say, like when you go to doctor, you know, there are heart surgeons, there are brain surgeons, there are tumor, there is a spine, and so on. There is, of course, you have a doctor that is just general practitioner, and what they do is they just sooner or later they just push you to another doctor, a doctor who is specialist in their industry, right? And that's the same thing in trading. Like if you diversify too much in the beginning, you are like general practitioner. Okay, so you can do many things, but you're not professional in anything. But if you are already, let's say, if you are a heart surgeon, okay, and then you're already professional, and then you start taking, let's say, you're brain surgeon as well. Sooner or later, you become. Okay, is that possible? That is possible. But doing those two things at the same time, it's impossible. That's the same thing in trading. If you start diversifying too much in the beginning, you will never gonna adapt. You're never gonna have exceptional trading skills. Okay, because of course you have to be in one niche first. So if you're beginning, you have to be in one niche. But once you already achieve certain results, of course, then you diversify and then you explore more and more and more and more.
How about you? Where did you start?
My first trades that I entered was coffee beans.
Okay.
And but I didn't know at that time, right? Because when I first traded, I actually didn't know what is trading, so it's pure luck anyway. But after that, it went with currencies. Okay, so with currencies, I didn't touch gold for many years. So it's only currencies. But also when I started to learn how to trade, was very different because there were no moving charts, right? We had to draw charts ourselves on a millimeter paper. We had to use a meta stock to input the highs, lows, open and closes. So it was very different. So that's why it was way easier to stick to one niche, because it's impossible that you will get. Imagine for you to get a chart. That means before there's meta stock. Guru, remember meta stock, right? That you don't have the prices. Okay, so you input your own prices, meaning your chart, the candlesticks, you input every hour yourself. There's no such thing as 5-minute candles. Okay, the best thing you could do is 1 hour, meaning for every hour you have to call to the broker to get the highest price, the lowest price, opening price, and closing price. So imagine if you would trade 20 products, can you realistically do that? Of course not. So you limit yourself to maximum 5. So back then it was way easier to kind of control yourself in one niche, because you genuinely have to do a lot of work to get the chart. Now you go on MetaTrader, TradingView, and you have unlimited charts, and that's why people get confused. Oh, I want to trade everything because I want to make money from everything, and then they end up losing money on everything. So yeah, but back then it was different, because there was not so much information. Information can help you, but information can also kill you. Finding information on the internet is same thing like if you have a fire truck, okay, and then you're trying to drink from the hose. If you're really thirsty and you're gonna try to drink from that hose, when they switch it on, you're dead. That's the same thing as finding information on the internet. Okay, too much information kills you. So you have to be very dissective. So bottom line is, I would probably preach that everyone chooses like five products to trade first. Only after that, when you are really good at it, then you start to diversify more. But if you start diversifying in the beginning, it's tough.
All right. But if you are to advise a beginner, where should they start right now, and what type of trading? Let's just say, last time, we made it to a point that there are no scalpers, swing traders, etc. Only profitable and non-profitable
Yes.
traders. But if you are to advise a beginner, what assets should they start trading if they are starting, and what type of strategy or style? Let's just go to the scalping or day trading or swing trading. Where should they start?
Okay, for a beginner, also number one depends how much time they have. So let's assume they have a lot of time on their hands. Okay, I would not advise stocks per se. Not because I don't like stocks. I like stocks. Like it could be CFDs. You could trade CFDs when it comes to stocks, CFDs. But underlying stocks probably is not good for a beginner. Not because it's a bad asset class. It's a really good asset class. But it's going to be problematic for you if you start trading during the bearish market, during the bear market. Because in the stock market, underlying asset you can buy or you can sell. You can buy and then you sell it at a higher price. You don't do short selling. So that becomes problematic. And if you start in a bearish market or you start in a bullish market, you will have the wrong perception of the market. Okay, so either you have a losing streak, or either you will have everything you buy just goes up. So let's say just when they start cut rates, COVID, and that's why many people made a lot of money in US and other countries, because you are locked. You're locked in your house. You have nothing else to do. So you open your account in Robinhood, and then you start trading stocks, and everyone is making money because all stocks are going up. And then, bam, everyone is losing money because suddenly what happened? Strategy is not working. No, the market changed. So at this moment, I would advise probably people still start trading either the stock CFDs, currencies, or established crypto futures. Okay, so like not like small altcoins, but crypto. Why crypto futures? Again, because you can go long and you can go short. Okay, then when it comes to strategies, I would still probably preach for day trading, not because I think day trading is more profitable than swing trading, but because when you do day trading, That means that you will analyze market every single day and maybe will have a trade every single day. So after 1 year, you have had around 200 trades. Okay. When you do swing trading, maybe within a year, you will have 5 trades. Out of 5 trades, if you made all of them high profit, it could be just pure luck. It could be the factors. But if you do 200 trades, and out of those 200 trades, 60% are profitable, that means you genuinely learn how to trade already, right?
Yeah.
So that would be my advice.
And that is consistent if you are harnessing a skill in anything, right?
Yes.
Quality is more important than quantity is more
Exactly.
important than quality.
Yes.
If you are beginning to learn a new thing or a new skill. All right. Okay. I think last 3 questions. What are the differences that a retail trader does versus an institutional trader does in terms of strategy, psychology, or technical analysis, etc.? So Kevin said.
Well, the first biggest difference is institutional trader has way more money. The second thing is that a retail trader has a hope that he will outperform the market, while institutional trader knows that he won't outperform the market. Okay, so so it's a different type of thinking. Like retail trader thinks that they're gonna be the next George Soros or Warren Buffett or so on, while institutional traders they know very good where they're at. Okay, retail trader thinks that they have to make money every day. Institutional trader understand that they have to make money by the end of the year. Okay, so that's very big difference, because then that works with your psychology. When you think that you have to make money every single day, that means you will make mistakes every single day, and that's the main point. As far as when it goes to strategies, institutional trader strategies are not that amazing strategies as you think. Okay, like they're actually very, very simple strategies. Like institutional traders use genuinely simple strategies. Okay, so let's say, because they have all the time in the world, okay, which retail traders don't have. For example, okay, so basically, institutional trader, the approach when it comes to institutions is so much more relaxed and much more steady than when it comes to retail. Okay, so let's say you draw your buy zones, sell zones, and so on, and then let's say you draw your lines. Like institutional traders are very simple. Okay, you would draw just the simple lines like a trend lines, and that's it, and then that's when you go. Okay, so you draw it, bam, you start buying. Okay, so you calculate what is the worst case scenario. So they're not just gonna cut loss here. Okay, you're not gonna cut loss here. Basically, you're gonna buying and you're gonna start buying, and they use grid system. Institutional traders don't have just one position. Okay, they keep adding on their positions. The thing is, because they have more money, and also the points that they use are more extreme points because they use way longer approach. Now, that doesn't mean that they don't trade every single day, because they just trade everything under the sun. Okay, so then you buy, and it's very simple. Let's say it's a time scale. The time scale is the biggest difference. Okay, so time scale, because institutional traders, they will use completely different time scale, because they aim to make money at the end of the year, at the end of the 3 years, at the end of the decade. Okay, they're not aiming to make money with every single trade that they have. Let's say if this particular case GBP USD, they're not aiming to make money with this particular trade, because within 1 year or within few months, because they have other trades. Let's say they are also trading Bitcoin. Okay, so let's say GBP USD, they're not gonna make money by the end of the year, but let's say Bitcoin, they make money. Okay, because again, you have the analysis of the market is much more simpler than people would think. Okay, so what happens with the retail trader? Retail trader want to trade Bitcoin, and they want to trade it every single day. Okay, or every single week or every single month, because that's, oh, I'm a crypto trader now. Institutional traders, they are crypto traders as well, but they're not going to particularly concentrate on Bitcoin only on that day, because they will say, okay, so this is extremely strong support. So let's wait when it is going to go to 19,000. And when it goes to 19,000, that's when they start buying. Okay, so this year, if you would be institutional trader with a decent amount of funds under your management, you would be making very good money on Bitcoin already, while maybe your positions on GBP USD are still floating and negative, because again, what you're looking at the general bottom line. Okay, and that's how the hedge funds work, because they'll look at the general bottom line. Now, it's very hard, the same thing if you do even if in a PAM, it's very hard to do the same thing. Why? Because your clients still know the positions, monthly returns, and so on. So there's completely different approach to trade for institutions or trade for, let's say we trade for investment bank.
Yeah.
Investment bank, they are only doing reporting to their clients at the end of the year. So they just want to have upside by the end of the year. That's it. So that's the very big difference. And then you could have, let's say you have many different products, right? You could be trading many different ways. So let's say you have GBP USD, then you have Bitcoin, then let's say I don't know, maybe it could be it could be volatility index. Okay, so you could be trading volatility index. Like volatility is one of my favorite products that you could trade for institutions, because the chances of losing money are 0 to none. Okay, but again, retail traders, they don't have time. They don't have time to wait for volatility index. It goes to the position that you can make money. Okay, so the timing is the difference when it comes to retail trader and institutional trader, institutional investor. Retail trader want to make money every single month because they use that money to support their life. The fact is that now, if I trade for institutions, I start bashing in volatility index, because if you buy volatility index at this zone, there is literally 0% chances that you will lose money. But can you promise that you will make money by the end of the month or by the end of the next month? No. But I can promise 100% those positions will make money, a lot of money, obscene amounts of money.
That's quite too much to take, I think, for retail traders. But yeah, that's the truth. So this means, yeah, of course, since you already brought out that you are trading for investment banks, okay? Like, let's just say for that investment bank that you're trading for, can we know how much is, or what are the terms? Is it 12 months, 24 months? What are the targets?
We have, so for investment banks, we have two types of portfolio. We have a 1 year term, and then we have a 2 year term. Okay, so that is, they use both types of portfolios, because what investment banks does is they create a fund, right? And then clients invest in their funds. Or they create a term deposit and client invest in their term deposit. So some are 1 year, some are 2 years. Okay, so currently, let's say, like, most of them are using both. They have 1 year and they have 2 year. Well, of course, it could be 5 year also, but like with us, like currently what we have in active portfolio is just 1 year and 2 years. Okay, but it's not because of us. It's also because of the institutions, like, because it's really a question how they want to invest, not just how we want to trade. Okay, so we have 1 year and 2 year. So what we have with them is, because I know that they pay to their investors a fixed term as 13% a year. Okay, So they pay to their investors 13 to 15, depending on a 1 year or 2 year period. Okay, I think 1 year is 13 and 2 years is 15. I might be wrong about the terms how they pay to their investors, but I think it's 13 and 15. Okay, and then we with us we have terms that we share the profits. Okay, so we have the cut loss point. Okay, same like with MDT and any other products. So there's maximum risk exposure. So for a 1 year product, their maximum risk exposure is 10%. Okay, and for a 2 year product, their maximum risk exposure is 30%. Okay, now that means we cannot go beyond this 30% and or this 10%. Now the profit is shared, but of course their capital is bigger. I think the one, like if we talk about one particular bank only, then the 1 year product is
25.
12 million or something, and then the 2 year product is around 20 million something. Okay, and then but of course because of the risk exposure and everything, so you just trade differently. Not differently, actually very similar, but you just have more exposure because you can trade so small positions. Okay, with 20 million you can trade 0.01 and you can do your zone for a very long time, right? And you will be profitable. And then we have the profit sharing. If we are I think if I'm not wrong, our terms are that we only start sharing profit once it is above 18%. So the first 18% is strictly to them. So 13 to 15 they give to their clients, and the rest are their income. And then above 18%, we have the performance fee.
All right. Okay, so different terms, right?
Yeah.
For different clients. So this means that, well, the difference is because we have like for example, for all of us, majority of us, well, I think all of us that are here right now are retail traders and retail investors as well. So can you say that if you want like a long-term result for investing, we should adapt the retail trader side of mindset or psychology in terms of being clients?
Yeah, of course, because that's why institutional clients make money, because they eat the retail traders, right? Like, where does the money come from? It's a scale, right? So you have retail traders because they have the short-term mindset and they feed the institutional traders. They feed the institutional clients. So all the money from the retail moves to institutions, and that's it. So if you will have the mindset as institutions, then you will be fed, because it is impossible to change all retail investors and traders' mindset. It's impossible. That task will never happen. Okay, because financial market is very psychological, and the big institutions, they are incentivized to feed the information that will keep retail traders in their short-term mindset. Okay, so it has been already since the first stock exchange was set up. It has always been this way. And it will never change. And now there is just more products, more exchanges, more. There is forex, stocks, crypto. There's in the future there's going to be other things, carbon credits, and so on. So it's just going to keep getting worse. So people will have this short-term mindset. Now it's very, very hard to overcome, especially if you do business and you trade for people. It's very hard to overcome this short-term mindset, because let's say, for instance, you want to do good business, okay? So that means you need a good client base. But let's say this month you only made 0.4% in your pump. So that means what's going to happen? Those clients not going to go and not going to find new other clients. Your marketing is not going to be incentivized, because they will think, we're making so little money, because they don't see the big scale. They don't see the big picture. While institutional mindset is very simple. I don't care what I made this month, because I know I'm going to make a lot of money by the end of the year.
True. All right. So, do you have any other question for our audience? I think one of the last questions is, since we're talking about retail traders, and well, one of the more prominent mindsets that a retail trader has is having that FOMO, right? the fear of missing out. So how can you prevent it?
I think you can't if you are on a retail side. because the only people who can prevent the fear of missing out is when you already have a huge amount of money and you just don't care. And even those people very often get sucked in. Okay, so that is you. There is no way how to prevent it. I think every single person sooner or later gets sucked into it. It's just the question: you get sucked in with a big amount of money or with a small amount of money, and that's it. But you cannot prevent it. You genuinely cannot prevent it. Like it starts with education, like financial literacy and so on. But even those people, they can still get like I think everyone like crypto is a very good example. Let's say like this: what was the reason why people invested in Luna?
Right?
FOMO, right?
Yeah.
So, and how many investment banks, hedge funds, and institutions invested in Luna? The smartest minds in the world, right? The smartest minds in the world invested in Luna. Okay, how about FTX? The smartest people in a financial industry bought shares in FTX. Not only put their money in FTX, but they bought shares in FTX. So I think FOMO, it's not just for retail, it's for everyone. It's just the difference is on how big of a scale it is. Like people have like Solel Bank and so on. They have done due diligence on FTX and they still lost billions. Three Arrows Capital, the Singapore digital hedge fund, they have done due diligence in Luna and FTX, and they still lost $3.8 billion. Because let's be honest, what is FOMO? Trading is based on FOMO, right? Like when it comes to technical analysis, like let's say when it comes to supports and resistance, let's say you're working with 5 supports. Why just don't wait for the 5th support and only buying on a fifth support? But why we are all starting, okay, first support, second, then adding positions? Because it is a fear of missing out, regardless how we look at it. Why just don't look at all-time lows and all-time highs and only then entering the position? Because we fear how if it's not going to go to all-time low, but going to reverse before that. So just a retail population just have slightly different mindset. But when it comes to institutional traders, they still follow the same factors because we are still people. As long as the human emotions will be involved, FOMO will happen. We all will have fear of missing out because that's how we are wired.
All right. I think that's very clear for all. Okay, this will be the last question for this session. How do you adapt your trading strategy to changing market conditions or evolving trends?
We run our strategies parallelly. So before adapting the trading strategies, we already have the ideas. Okay, maybe you should change this and that. So you still parallelly trade on your existing strategy, and parallelly you also trade on your adapted strategy or a few adapted strategies. Okay, and then you just see how it performs better or worse. So that's how you change. So you change parallelly. So you don't just switch, but you parallelly run few different scenarios, and then you see, okay, so at this moment this works better, and then you do the switch. So that's why trading is continuously evolving process. You continuously try to adapt something, you run parallelly. That's why I told you it's so important for you to have different trading accounts. It doesn't matter if it's demo account, live account, as long as it's the accounts that represents live market conditions. Okay, you could run 10 different strategies that by just changing a little things, and then you say, okay, so this works better. It doesn't mean that you stop running all the other strategies. It just means that your live account you use this way while you still run all the 10 other strategies. And now it looks like this starting to perform better. Then you add your live account to this one, and you keep doing that all the time.
But okay, but only professionals can do that, right? because for example, you're a beginner trader, you have a job, of course, you're focusing on one trading strategy, and like for you personally, I think you have like 14, if I'm not mistaken, like 14
Yeah.
strategies that you are simultaneously running, because
Yes.
that is your business. But for
Yes.
like beginner traders, so how will they do it? Okay, so they will be focusing on one first.
That's why it's so important to have a team. Even if you're a beginner, it's important to have a community. So I don't believe that you can make money as one person. It doesn't. You don't have to sit together with your friends or team together, right?
Yeah.
I mean, you like now in a trading view is beautiful. You can create your own chat room. It's just between yourself. You can all be drawing on the same chart. So what you draw, your community sees, and that's a discussion. So it's like you don't even have to be in the same place anymore. So that's how far the technology has evolved you, that whatever you draw, anyone else also, I mean, you don't have to share. You create a private chat and you have the same chart and that's it. And it's like it's beautiful. So, but just doing yourself, again, trading alone, completely alone, it only can bring you as far. Okay, you never can be professional. In my opinion, you cannot even be in intermediate level. Okay, if you're just alone, you need other people. You need other people that, because other people, not just that they will trade for you. I mean, other people that by having this community or colleagues or friends, that means that you will get information from them that probably you wouldn't get. Okay, it could be just gossip, and then you go and do your own due diligence check and everything. It could be ideas that somebody said, oh, now it would be a good time to buy Euro South Africans rand. Maybe you never even look at Euro South African rand, just because they mentioned, then you go and see it. Oh yeah, it's a really good time. So that is important. When it comes to strategies, also the same thing. You probably can run two or three approaches yourself at the same time. But if you want to run more than that, then you need somebody else. Okay, so being a lone fighter, it's impossible. People think, oh, George Soros made money. George Soros had very little to do with making billions of dollars in Deutsche Mark or in pound sterling. It was actually a guy under him that brought him the idea. So that's how it works. It gets, so the line is from the bottom to the top, not from the top to the bottom. Okay, so and that's how it works. Like when Michael Saylor invested in a Bitcoin, it was not his idea. He get this information that Bitcoin could be something amazing, and then it started from there. And that's how it works. And that's the same thing with the strategies. If you're just going to trade yourself, you're not going to have, unless you are wired this way that you really like trading. There are few people in this world that just like trading as because of trading. Okay, they just like to look at the charts. They just like, regardless what happens, most of the time you're going to look at the chart. So that's different. Then you can have your own ideas. But most people, I would say 98% of traders are not that way. Okay, because they are in it for the money, and it's nothing bad. Yeah, there is nothing bad to be in it for the money. Most of us are. But if you are wired that way, that you just like, let's say for me personally, I just like charts. Like sometimes I prefer looking at charts than watch a movie. Okay, so it's just different because you just like it. Okay, I can find something. You can, oh, this is this. But there's few people that way. Okay, so that's why you need to associate yourself with the similarly minded people, because they can look at your chart and they will say, hey, I think if you would do this, then maybe it would change. And then that's your second setup. Okay, my first setup is working, but how if I would just change this one thing? Okay, well, let me run two different setups parallelly. And then you see.
All right. Okay. So, are you satisfied with the answer, Ma'am Elisa? Okay. So, does anyone want something regarding the market? Maybe one pair, maybe a pair that they can ask
Sure.
of you. Do you have like a trade where you have like a floating loss right now, and then maybe Sir Yanis can have a look of how, based on gold analysis for month,
For
is that
Monday.
even possible? Okay, but well, generally gold, please. Okay.
Yeah, let's have a look at the gold.
The gold diggers. Yes.
Okay, so this is the gold 1 hour chart. Okay. So in my opinion, what will happen? In my opinion, we are in a buy range for gold. Okay. So based on my analysis. Okay, so this is a buy range for me. Okay, so that means starting from 1964 all the way to 1955, that's a buy range. So for me, I would utilize this as a buy. Okay, of course, what we have to see, we have to compare, we have to look what happens with the dollar index. Okay, so at this moment, dollar index is in a resistance. Okay, it's in a resistance. So if we want to buy gold, that means we need dollar to drop, right? If the dollar index drops, gold goes up. That's kind of common sense. Okay, it's quite strong resistance. Okay, when it comes to dollar index. Okay, we can see that this particular zone has played out in 2022, 2023 already a few times. Okay, it has the support. So so technically, we see that there's a resistance now. Okay, so as long as it's not going to bash through this resistance, that means dollar index it's still in a bearish trend. Okay, because it break through the support already. It broke through the support. Okay, so let's say take it as a daily chart. Okay, so if you take it as a daily chart, then you see even better that this has been active resistance zone, and it also has been active support zone very few times already for many years, right? If you can see it dates as far back as 2016. Okay, so it's very active zone when it comes to dollar index. So that means it has been active support, active resistance zone. At this moment, it acts for us as an active resistance zone because the support was already broken. Okay, the support was broken. We had multiple days closing below that zone. Now it's getting back. So that is a resistance zone at this moment. So it kind of goes with our thesis that the gold is in a buy position. So number one, dollar, we expect that the dollar should be going up. Of course, if we will have that the daily candle comfortably close above this zone, that means that's it, that the resistance was broken and the thesis does not work anymore. But at this moment it does, and that means this is the this is buy zone for gold. So basically what I would do is I would just fill in this zone with the buy positions. Okay, and I would expect that gold can move higher. Okay, so that gold maybe potentially can go as high as $2,000. If it breaks this zone, I would stop buying. I would not cut the positions yet. Of course, depending on what is your risk exposure, because I don't know, depending what is your lot sizes that you're using. But if your lot sizes are not that high, I would just stop buying and I would not cut the positions, and I would aim for this zone. So this would be my second zone. But if your positions are too high and you have too much risk exposure, then it's better to cut loss.
Okay, I think for those who ask the question, I think they are asking this for the prop trading accounts that they are managing. So just like what you said, like you will be bashing in buys on those on that level. Would it be
Yes.
possible for like a prop trading account to do it?
Yes, it depends. Let's say if you are in my Forex funds, no problem. If you are in FTMO, no problem. EverTrader, no problem. If you are in Bespoke, because as I know in Bespoke, you cannot have more than 3 positions on the same product in a like you cannot do multi-angle more than 3 positions. So then you have to calculate. But if you're in MFF, FTMO, then there is no problem. Okay, you can do 001 and so on. But if you are in a Bespoke, then you have to calculate 3 different positions. So let's say you would take 2 positions in this zone and your third position would be here. So you just have to calculate the proper risk factor.
All right. Okay. So satisfied, Sir LJ, Ma'am Jelay? But of course, you really can't predict what will happen on Monday, right?
No, or you cannot just at this moment if the conditions should, because it's kind of factor of things that the dollar index is there, gold is also there. Okay, so what we have seen is if you look at the dollar index, you have seen lower lows and lower highs. So we are in a downtrend. Okay, it's very important to establish the trend. We are in a downtrend. Okay, so we have lower lows and lower highs. Yes, yesterday a lot of dollar products went up. So like USD JPY had a spike. But what happens? They shake out the people. Okay, they give you false assumption. Okay, so you will have okay, so it's gonna start going up. So you have to understand we are when it comes to dollar, we are in a downtrend. Okay, very simple. Lower lows, lower highs. That's a downtrend. Higher lows, higher highs, uptrend. It's in a resistance now. Okay, we have confirmed that since 2016, strong zone. It's in Does that mean 100% that it's gonna go that way? Of course not. But again, that is technical analysis and that is trading that you work with probabilities. At this moment, the idea and the probability is that dollar index should go down. And because when dollar index goes down, then the gold goes up. Okay. Also, most likely, Fed is kind of pausing on a rate hikes and so on. So the fundamentals also follow the thesis.